We have been anticipating the impending crash for more than 2 years. The past 6 months have demonstrated that this has begun. The soaring stock market can be destroyed with just a 1 or 2% rate increase. Several businesses that saw their stock prices increase throughout the epidemic lost all of their gains and have returned to their pre-COVID levels. Whatever was sold prior to the crash must have made a significant profit. However, because the top 10% of Americans control the majority of these assets, the stock market meltdown is not a great concern. However, because everyone had a roof over their head when real estate values plummeted, everyone suffered. In 2020 and 2021, the price of homes rose by almost 10% and nearly 20% respectively. Since the housing market was on the verge of a crisis that would bring down the entire economy in 2005 or 2006, we hadn't experienced such price increases. House prices are also hurting because the Fed is raising the rate. Would the 2008 housing crisis therefore recur? This would be a topic that many people have been wondering about. Is a comparable disaster on the line for us? How severe will the impact be? We'll explore the answers to all of these questions and many more in today's video. We will be talking about this housing market crash that will be much worse than in 2008, so you can get ready now. But before that, it would be lovely if you subscribe to our channel. You could also unsubscribe at any point, but as long as you subscribe, you'll always be the first to hear about new money-making strategies as they become released. Hence, it is mutually beneficial. So, how about we keep going? The 2008 housing bubble was caused by various circumstances, unlike the current crisis, which was caused by a separate set of variables. Rating agencies' issuance of overrated mortgage-backed securities was caused by loose banking laws. The loans with the highest likelihood of defaulting were mixed in with the strong loans and awarded AAA ratings. Based on the claim that these loans are of steady grade and are insured by sizable financial institutions like AIG, investors traded these securities. But as some of these loans started to fall apart, it set off a chain reaction that brought about the market crash and the failure of enormous companies like Lehman Brothers or AIG. Many people, however, are under the impression that the housing market is healthy since the present housing bubble is not being fueled by subprime loans or false AAA ratings. However, we also need to remember that no two crises are exactly alike. Every crisis or bubble is unique. When a crisis occurs and we take action to address it, we learn the lessons and do our best to prevent it from happening again, at least in the near future. Because of this, obtaining a mortgage has never been as simple as it was before the housing crisis of 2008. Therefore, it would be foolish to assume that the current crisis will proceed just as the prior crisis did. We need to examine the causes of the steep rise in housing prices, as well as the likelihood that they will fall. A crisis is a possibility if there are such signs. After the housing market fell in 2008, several home builders filed for bankruptcy because it was no longer lucrative to build homes. Only the most reliable businesses made it through the crisis. The government imposed banking rules, which resulted in a dramatic decline in housing demand, making it more challenging to sell homes. But since then, a lot has changed. Although banks are still subject to regulation, obtaining a mortgage isn't as challenging as it was immediately following the catastrophe. Since the supply of new homes in the US was constant, the housing market started to expand at a maximum average rate of 1 to 3%. However, if you look at the facts, more developers entered the market when they saw that the demand for homes was at an all-time high and that mortgage rates were at a record low. Even though the destruction caused such a severe scarcity of real estate, starting in 2021, the supply of new residences started to increase to the point that it is now almost twice as high as it was before the pandemic. Since the Fed is hiking interest rates at every available moment, they have started lowering prices so they can sell. People overpaying by up to 50% simply to purchase a certain property has been documented in numerous headlines. Additionally, the media was proclaiming everywhere that we had no idea when we would be able to return to work at this uncertain time when we believed the world would end. People became anxious and hesitated to sell their properties out of concern that they might miss out. In contrast, the media is no longer focused on COVID cases, and consumers are returning to their pre-COVID lifestyles and selling their homes in 2022 when we are confronting issues like the actual conflict in the center of Europe, which is jeopardizing the current global order. Certain individuals took 2 years to finally sell their properties. When prices would increase the following day, why sell now? The most recent time we experienced a similar crisis was in the late 1970s, during the Iranian Revolution, when oil shortages sent shockwaves around the world and drove up oil prices. Inflation alarmingly topped out in 1971 at 11.3%. The percentage increased to 13.5% in 1980. Following it, a recession hit the economy. Statistics show that, for a variety of reasons, the situation is significantly worse now than it was back then. Russia is not Iran to start with. Russia is substantially larger and has a strong economic integration. Not only does it export a lot of oil, but it also supplies the most gas and exports the most. And it is invading a nation that is among the biggest producers of wheat in the world. Furthermore, there was a pandemic that affected the entire world, forcing us to print trillions of dollars to compel people to stay indoors. By January 1981, the Fed had increased the rates twice, first to about 10% and subsequently to 19%. Consider for a second how high mortgage rates would be if interest rates were 19%. I believe mortgage applications would decline so drastically that home builders would begin declaring bankruptcy once more, similar to what happened in 2008 or 2009. Before we continue, we would appreciate if you share with us in the comment section your experiences in the recent pandemic, or in the 2008 crash and how you managed to get through it. Once you're done, let's get going, shall we? Since the demand will just disappear, people will lower their prices even further to sell. Only those who have cash would be capable of purchasing. By the way, more than 65% of homeowners use a mortgage to finance their homes, while only a third of buyers paid cash. When borrowers with a poor credit history fell behind on their mortgage payments, values started to drop by 10 or even 20%, which is another factor that contributed to the 2008 housing market crisis. The homeowners that could really pay their mortgages discovered that their $500,000 mortgage was now only worth $400,000. As it made no sense to continue paying a mortgage that was significantly more expensive than the actual value of the house, they also defaulted on their mortgages. That further depressed home prices. A similar pattern is now evident. Only last year, house prices increased by about 20%, and this year, builders are reducing their costs. Mortgage applications are declining while the number of available listings is increasing as a result of rising mortgage rates. The Fed will continue raising rates to crush demand if inflation does not decline. Additionally, since the globe is on the verge of an oil and food catastrophe, a recession is very possible, which will further reduce demand and drive down prices. What would homeowners who took out mortgages in 2021 do if the cost of property dropped by 10 or 15%? Will they continue making their exorbitant mortgage payments? Possibly yes, possibly no. If the answer is no, can the Fed manage to reduce rates once more? After several rate increases, it cannot even reduce inflation. In the near future, I don't believe they will take the chance of lowering the rates. We all have to deal with the recession. I am aware that the Fed frequently asserts that there are no indications of a recession. However, the Fed is quite cautious in its statements. The Fed's words are quite essential. Keep in mind that we already knew that inflation was out of control by 2021. By claiming that there are no indicators of inflation, the Fed managed to soothe everyone down. However, the Fed alerted the market instead of immediately raising rates when it occurred. The market paid no attention. They cautioned it once more, but it dismissed it again. Only after this did they act, raising the rates. The US is hardly in a recession, they reassured. Then now, the possibility of a recession is being raised by Jay Powell. Because the Fed's role is to constantly remind investors and ensure that the recession is not as terrible as it could be, I wouldn't really put my trust in it. A housing crash that is somewhat reminiscent of the 2008 crisis is a reasonable possibility if circumstances remain the way they are today. but only time will be able to tell for sure what will happen after examining all of these data now. Thanks for watching. I hope you learned something meaningful from this video. And for more videos like this, don't forget to subscribe and hit the notification button. Until next time, see ya!